Well, let me revisit the Beyond Meat options short that I had put on May 7th, or at least the video that I posted was May 7th, that I had put on Beyond Meat. And since I put it on, the price has been elevated and it has stayed in the 130, the upper 130 range. So I've had a number of emails and comments under the video of, well, how do you risk manage? Because I said that I would risk manage my position long before it started to hurt me. And risk management when you're dealing with options is, I look at it in three stages. There's the pre-trade risk management, there's the post-trade risk management, and that is two phases depending on where the price is. So I'll explain to you how I've been managing the risk on this position. And you'll see that it's really nothing special, but it is worth explaining because I think a lot of people out there don't have the benefit of being on a professional trading floor where they can actually see this going on and they can sort of get a feel for how this is done. On the screen, you see a chart of Beyond Meat. So I'll set up what I did, and then I'll explain what I've been doing since. This circle right here is where I put on the trade. This was after earnings. It was not just the day after earnings, but the day after. So it was it ran up, I think, to 129. And then I thought, well, there's our short position. I bought a put at 120. So I'm long this put, so I make money on anything below that. And to finance that put, this is 165 up here because the chart doesn't go that high. This is 150 here, that's 165. I sold two calls at 165 to finance the put at 120. And at the time when I did the video, I said I only took a small position. I only did 3 contracts. For me, that is a very small position. Which means that if this thing moved against me, it was so small compared to my other positions that it wasn't going to affect me. Not only that, you'll also recall in other videos I've done that I am long the SPY with pretty much the same trade. I buy a call and I finance it with 2 puts much lower. So if the market is going up, that trade really works out for me. And if Beyond Meat goes up with the market, well, Beyond Meat doesn't work out. Level 1, remember what we learned in level 1. If we take 2 risky assets and combine them, we can end up with a portfolio with much less risk. So again, I'll give you the example I gave you in the reading. I believe it was the second or third reading in portfolio management at level 1. Let's buy a ski hill. Busy in the winter, it's dead in the summer. Let's buy a golf course. Busy in the summer, it's dead in the winter. Take the golf course, take the ski hill, put them together. You have much lower variability in your revenue and your net income by taking 2 risky assets and combining them. So when we look at the risk of a position, we should not just look at the risk of that position on its own, but look at the risk of the position in combination with everything else you have. If you have a portfolio that has a long bias to it, you can support a number of short positions that move against you because your long positions will pay off as they move against you if you're wrong. Hopefully you're not wrong. Hopefully you're right. That's part of risk management, is monitoring the position. But if they moved against me, I had enough long position that I would be covered. Plus I said I did it small. I only did 3 because for me this is speculative. This is not something I want to bet the farm on or potentially lose the farm. It's speculative. I want to be in the game. I want to hit a single with it, but I'm not looking to knock it out of the park. So there we go. That's risk management number 1, is what is my position size going in? If you size your positions going in and you look at the whole total sum of your portfolio and you ask yourself, I'm bringing on negative delta here. Do I have positive delta in my portfolio? I'm long a put. That has negative delta. I'm short 2 calls. Calls have positive delta. I'm short positive delta, which means negative. So I'm bringing negative delta into my portfolio. Do I have positive delta? I got lots of positive delta. Okay, I've got a little bit of a natural hedge going on in there. There is risk management number 1. Let's say that I had a complete short-only portfolio and I'm bringing on more negative delta. I'm actually increasing my risk by bringing that position on, not decreasing it. This actually decreases my risk because if the market really comes down hard, I don't expect Beyond Meat to hold up. I expect it to sell off as well. Well, beautiful. I've added negative delta. So if you look at the dollar delta of my portfolio, it actually shrunk by adding it. That's risk management. That's the first thing I did. I sized the position to a point where I said, this is not going to hurt me if it moves against me because it is speculative. And then this is what happened. Look at that. And up it went, and it breached the 140, hit the 145, and very quickly, within the first week, it went from the upper 120s to mid 140s. So, of course, when it does this, you don't panic. I have 165. Above 165 is where I'm really going to start to change the risk management that I do. Between 120 and 165, I've written it down here. This is what I'm concerned about mostly is liquidity management. I don't want to be knocked out of my position. As this thing moves up, because I have negative deltas, what's going to happen is my put delta is going to decrease, but my call deltas are going to increase. The negative delta I have is going to continue to increase, which means each dollar up is going to hurt more and more and more. Do you get that? As each dollar goes up, the deltas will get bigger and bigger and hurt more and more. So I don't want to be knocked out of my position. I want to, if I'm wrong, I want to exit my position, but I don't want to be forced to exit my position because I didn't manage my liquidity. That sucks. That's a bad way to have a position end on you, is to be forced out because you didn't manage it properly. So as it's going up, I've got plenty of liquidity. I'm okay. I look at this and I say, what's going on here? And then you start to look around. Has anything happened that would change my mind? If you're going to be a successful trader, you have to understand this. Nobody in the history of this game has a 100% record. Nobody. If you saw Warren Buffett's Berkshire Hathaway general meeting a couple of weekends ago on YouTube, he broadcast it live. He said he exited the airlines. He made a mistake. He exited the airlines. He took like a $2 billion hit. Even he makes mistakes. Nobody has a perfect record. He bought something, new information came along, he was willing to change his mind. You have to be willing to change your mind. So this is going up, and I'm saying, is something happening that would change my mind? So I went looking around. And I found a combination of a couple of things that I said, oh well, that doesn't bother me. There's a short position in the stock of about 20%. It's a small float stock. So to engineer a short squeeze on this stock doesn't take much. So all you gotta do is push the price up a little bit and you'll scare some of those weak hands that are short. They'll start covering, and that's called a short squeeze, where the stock just jumps right up because everyone's covering. And the higher it goes, the more people have to cover, the more they rush in, and it squeezes the price up. What started that, those little short squeezes, was Kramer. Is that he said, buy, I think this is the next Tesla, it's fantastic, and off the top of his head he said, I love the stock, up it goes. Kramer has got about a 50% hit ratio, which means he's just as good as flipping a coin, which makes sense. If you're going to throw out that many recommendations every night off the top of your head without really thinking it through, you're probably going to end up just as right as you are wrong. You're going to be a coin toss. That's all Kramer is a coin toss. But he's a coin toss with a platform, with a lot of people that listen, with a lot of sheep that come in, a lot of weak hands. These are not strong hands. These are weak hands. So I thought, well, this is just the sheep coming in. Let's give it a few days, because the sheep will come in and momentum crowd will come in, but these are weak hands. Any weakness in it, they're gone. And Kramer is just as right as he is wrong. And on this one, he's wrong. So, I didn't feel that, well, this is not somebody that I respect their work, who's done their due diligence, and I know them for doing due diligence, who said buy. If Warren Buffett said, look, I'm all in on this one, I'm out. I'm not short anymore, because that guy did his homework. I'm out. But it's just Kramer. It's just an entertainer that said it, and he does have about a 50% hit ratio. He is just truly a coin flip. That's all he is. So I looked at that and I said, okay, I'm not gonna be squeezed out. Number one, my liquidity is fine. Number two, that information does not change my mind at all. Now, if you're into the technicals at all, and I'm not a technical analyst. I don't believe in technical analysis. However, I am schooled in technical analysis because I want to see what they're seeing. Because if there's a clear pattern on the chart, I know that a bunch of people are going to see the same thing and they're going to act in accordance with that pattern. If you're a candlestick charter, see these long wicks? Look at these long wicks at the top. That's a lot of selling pressure when you get up there. When you start to see the stock going up and coming down and the candles are forming these really long wicks, there's a lot of selling pressure up there. That shows up on the chart. That means something. People will start selling at those levels as well. The other thing that you see on this chart is if you draw it out, you have a right pennant flag formation. And a right pennant flag formation is a consolidation pattern. That means the bulls and bears are getting more and more even as time goes on, and in a consolidation pattern, you should see volume dropping into the peak. Look at that. That is a classic consolidation pattern. It is called a continuation pattern, actually, because it should continue in the way that it was formed. So you have a right pennant flag formation. This is your consolidation, and it's a continuation. It should break out. So we have some technicals saying it looks weak, it looks toppy. And we have another one saying, well, it's a right pennant flag formation forming. You have your lows that are increasing each time, and you have your volume dropping. Another way to look at it is, as it's continuing on, volume is dropping. There's no appetite to send this thing higher. There it is. So I look at this. I'm not looking for technical analysis to tell me what to do. I just want to step out of the way of something super, super obvious. There's nothing obvious. There is a bullish chart pattern. There is a bearish chart pattern. And that's the thing about technical analysis, is that in a little while, one side will say, it was obvious, and they'll show you a chart, and you'll say, well, that was obvious, wasn't it? That was a perfect pattern. But it's going to be a perfect pattern whether it goes down or whether it goes up. That's the problem I have with technical analysis. That's the problem. Let's look at the fundamental story for a moment. I'll point out a few more things that of the sort of the technical part of the options themselves and the underlying that has happened since May 7th. May 7th, implied volatility on the underlying was 90%. As of today's close, implied volatility is 74%. What does this mean? That means that on every move up, it's not going to hurt me as much. So if it moves up $1, it's not going to be as bad as if it moved up $1 when implied volatility was higher. The other thing is 2 weeks have gone by. So I have some theta decay on this thing. And since I am short on the calls, theta decay, theta is my friend. I don't mind that. Which means the combination of lower implied volatility, the time, the 2 weeks that have passed, along with the combination of the underlying finding a hard time getting a lot of support above, well, right now, 140, it seems to fade very quickly above 140, all speaks well to me, which means that as it stays at this level, it's not going to continue to hurt me. I'm going to see the premiums come out of the calls, also come out of the puts, but I'm in a loss position on it now, but that loss will start minimizing. If this thing just continues to go sideways, I will not lose a penny because I sold these, or I bought the position at negative 50 cents, so I actually sold it at positive 50. I got paid to put this trade on. I got paid $150 to put 3 of them on. So if it just stays between those two bands, that's all I make is the $150, nothing more. So as each day goes by, as volatility drops, as theta decays, I get one step closer to a position where even if it went up $4 or $5, the longer the time goes, the more the stock can move, and I'm not going to feel it. So each day, each implied volatility percentage down. These are good things. Let's look at, let me finish this up. So basically my risk management at this point in time is in managing my liquidity. That's a big thing. You manage it on the way in with your position sizing. You look at the deltas that you're adding to your portfolio. You make sure you have offsetting deltas that work well in case this thing moves against you. You want something that keeps your portfolio volatility low without hurting you. And you monitor your position for information. Is there something coming out that changes my mind? Let me give you a good example of something that would change your mind. Let's say you're in a club and there's a little guy in there that's giving you a hard time. And it looks like he's calling you out. And you're looking at him and, you're walking the streets at about 2:15. This guy's $1.50, barely. I got this. Until your friend whispers in your ear, that's the son of the local mob boss. New information. I'm willing to change my mind at this point. I don't want to get into a scuffle with this guy. So I'll look at him, I'll say, sorry there, little fella, I didn't see you. And I'm going to get the hell out of there. That's new information. I'm willing to change my mind. I'm not willing to die for that one. Same thing with the trade. If new information comes out that threatens your original thesis, you don't have to die on this position. You don't have to make money the same way you lose money. Just exit, just leave. If it's bad, just leave. Or if you can hedge out, perfectly hedge out, which means you can buy some calls right then and there and minimize or lock in a smaller loss by doing that, fine. But the easiest way to hedge when you realize that you're wrong, new information has come out, just exit. No information came out that said I should exit. Kramer, I don't care. The sheep, I don't care. The momentum crowd, I really don't care. The smart people will win in the end. Let me show you some new information that has come out since I put my this short position on that just bolsters my belief that I'm on the right side of the market here. This is insider sales. Have a look at this. And look at the transaction. These are all sales. Option exercise followed by sales. All sales all the way down. Look who these people are. The Chief Growth Officer selling. The Chief People Officer. The Chief People Officer. Can't call it HR, right? The Chief People Officer. Seriously? Option exercise. And there's the Chief People Officer again selling. You have a director selling. You have the Chief Innovation Officer selling. Exercise those options and sell. Chief Growth Officer selling. And there it is, exercising their options and selling. The CFO and Treasurer selling. And exercising the options, selling. Your director up here selling. And you can see the number of shares are selling. 15,000, 20, 20, 50, 50, 50, 50, 35,000, 50,000, 35,000, 15, 50. I mean, it just goes on and on. Oh, sorry, I was reading off some of the option exercising. And you can see the value of what they're selling here. 2 million out, 2.5 million, 2.5 million, 6.5 million, 6.2 million. Does this sound like a group of people who are bullish on their own company? There's another page to this. This is just the first page. This goes back to April 10th, May 14th to April 10th. There's another page that goes back, I think, to the beginning of March. And this would have been as their sales were going up. Even before they reported earnings, I have to believe that the CFO and treasurer, before earnings came out, had to know what the numbers were looking like, and they were selling. And after the numbers came out, you can see the price at which they're selling at here. They're still selling. I have a business, and let's say that my business were publicly traded. I know how my little business has grown over the last few years. We have grown incredibly. If I were publicly traded, would I be selling my shares right now? Absolutely not, because I can see every day our growth. I can see the number of subscribers we get on a daily basis. I'm not selling. I know in 2 years we're going to be 3 times the size we are now. I'm not selling, but these guys are. These guys are selling. All of them are selling. It's not like it's one person selling. All of them are selling. Directors, people officers, CFO, treasurer, they're all selling. That's not good. Even after sales came out, they're all selling. After earnings came out, the price went up, they're all selling. Now, I get that you want to cash out at some point. I really do get that. But if you really believed that you were the next Tesla like Kramer thinks this stock is, if you really believe that, look, we're only $130 right now, we're going to be in Amazon, we're going to be $2,000 in 3 or 4 years, we're going to own the market, I'm not selling. If I really believe that, look, this is just the beginning, I'm not selling. I'm only selling when I think, look, I work in this company. Every single day I see what's going on and I'm selling. Enough said. I want to show you something that came from a newspaper. This is from the, well, you can see the title up here, the Nikkei Asian Review, food and beverage here. Nestle to serve up faux meat to pork-starved China. Swiss food giant will shell out $100 million for imitation meat production in Tianjin. $100 million, which is about Swiss, about 100, well, about almost the same price in US dollars, $100 million. Nestle plans to start selling plant-based meat substitutes in China by the end of the year. Exactly what Beyond Meat announced it was doing. We're going to spend a lot of money, we're going into China. Well, there's Nestle. Nestle is a diversified multi-product company. This to Nestle is a product. It's not their business, but it's Beyond Meat's business because Beyond Meat is a product. It is not a business line. It is a product. It is a technology. That's it. It's like a Crocs. When Crocs went public, I said, but it's a product. I don't care how many different kind of shoes you make. It's a product. It's a fad. It will not last. This is a fad. The brand Beyond Meat is a fad. Maybe there's a marketplace for plant-based meat out there. But do you know how many competitors there are out there? Tyson Foods, plant-based meat. Nestle, plant-based meat. These companies can survive a price war for market share far longer than a single product company like Beyond Meat. Far longer. Anyways, here we go. Betting its consumers will embrace fake meat. World's largest food company is doing this in China. You want to go up against them if you're just a little Beyond Meat? Spend over 100 million Swiss francs to expand its existing facilities and launch fake meat production. It's first in Asia. Plan to start sales of meat substitute by year end, and on it comes, and off it goes. Nestle generated sales of 6.9 billion Swiss francs from its China operations last year. 6.9 billion. Tyson Foods getting into the game as well. There's another one called Impossible Meats getting that just announced, I think, a huge expansion in California. Something like 1,600 grocery stores that it's in California. Getting shelf space, the right type of shelf space in grocery stores is super expensive. If you're a small, unproven brand, you have to pay for your shelf space. It's called a slotting fee. If you're a big company that comes with a lot of brands that bring customers in, you don't have to pay for that, and you get premier space. You get eye-level space. If you walk down that aisle where all the pop is and you look on both sides, you're going to see Coke and Pepsi. You want to find the off-brand ones, you got to look at the bottom of the shelves. You got to look way down at the bottom to find those off-brand ones, and they pay to be there. These guys, they don't pay because they bring people into the store. Nestle, Tyson, they bring people into the store. They have an advantage in just the sheer negotiating power they have with all these supermarkets, and they're already in there. They're already in these stores. So for them to add one more item into these stores, they can be in thousands of stores overnight. Beyond Meat has to approach each one and try to make deals to get shelf space into each one, and they're going to have the right amount of turnover. I priced out Beyond Meat, 2 burgers. It's like $5 to buy that. It's double to depending on where you buy, double to triple the price of hamburger meat. I might try it. I might try it on a summer afternoon barbecue just to try it. Hey, check this out. This is that plant-based stuff. Let's give it a try. And if it looks like meat and it tastes like meat, why not have meat? it's a third the cost, half the cost. So I may do it a few times, but I don't think I would do it on a sustained basis unless I really had some belief in why I'm with a plant-based product. Now, I'm not saying that some people would rather prefer that and abandon it, but on average, I don't know that the repeat sales are going to be at a very high level. You got a lot of competition coming into the space. And you have a company that has, and Beyond Meat has, negative cash flow from operations, and it's been getting worse year over year, going up against and it says right there, $6.9 billion in Swiss franc sales just in China. If Nestle wants that market, they're going to have it. If Tyson Foods wants the U.S. market, they're going to have it. Combine that with cell-based meat, which is real meat grown in a lab. It's cell-based meat. Memphis Meats, I think, is the leader on this one. And they're getting closer and closer to market launch, which is real meat. It's not plant-based meat. It's real meat without the cow. It's cell-based meat grown in a lab. This is going to be a very crowded space in a few months. By the end of the year, it's going to be very crowded. There's already lots of other meat substitutes out there. So, I combine this with the rally was Jim Cramer and his sheep. Who cares? The implied volatility on this thing has come down, which makes a position easier for me to manage. There seems to be a lot of resistance going beyond $140. You got insiders that are also sellers of this stock. And you have Nestle Foods and Tyson coming in, much bigger players, much deeper pockets, better relationships with restaurants and with supermarkets. They've got an existing supply chain already. They've got an existing distribution channel already. They don't have to build that. I don't see this little guy being the last man standing. I don't see this little guy winning, which as far as my short position here, I would be willing to add to it on any significant rally. If I see it try to peak back into the mid 145s, I think I would add one or two more combos on this one and increase my position. I'm even more affirmed of my original thesis than before. That's risk management. I'm managing my liquidity. I'm managing the information flow. I don't see anything that changes my mind. I don't need to delta hedge at this point in time. I don't think I'm going to have to. That's where I am. Now, one last thing to end this video. I am applying concepts from the CFA curriculum to real-world examples. And the only real-world examples that I can think of is something that I am actually willing to do, because I think it's important that I demonstrate that I don't just teach this stuff, I actually do it. And I think you want to learn from a practitioner, somebody who's been out there, who knows how it's done, who's made the mistakes, that can tell you what, and believe me, I've made some mistakes in my time, but can tell you what those mistakes are so you don't have to make them yourself, but can attach the content to the real world. I am in no way saying go ahead and do this. I'm showing you my thought process and how I think, how I get to this point. This is no different than the thought process you would go through on a trading floor. No different at all. Before you make a trade, if you were going to do a trade, before you make a trade, you're going to have to clear your position size with somebody. You're going to have to justify what your position size is and why you're taking that position. So if you think, well, you know what, I'm going to do 20 contracts. That's huge on a stock with an implied volatility of 90%. You're going to have to do a lot of justification on that one and saying that, but the position is free to enter. I'm actually getting paid to enter. With options, it's not just the ending price you got to worry about. It's the path that stock takes that could kill you. You could be right in the end, but dead because of the pathway it takes. Position sizing on the way in, liquidity monitoring while you have your position, getting ready to delta hedge if you have to all the time, watching for information flow. The moment you realize that little guy you're fighting is the son of the mob boss, get the hell out of there. That's risk management as well as knowing when to stop. Jim Cramer is not the son of a mob boss. He's an entertainer. I'm not worried. That's it. One more thing. I know I keep saying I'm done, but last point. On a number of videos I've done, I've had comments under the videos from different people saying something very obvious. You repeat yourself a lot. I do. It's just part of a teaching style that I have. If you say things once, and I've learned this through the years in classrooms, if you say things once, 50% of the people will hear you. If you say it twice, about 75% of the class will hear you. If you say it 3 times, you can reach 90%, and no matter how many times you say something, there are some people that will never hear it, that you'll never reach. So if you feel that I repeat myself a lot, that is intentional. That is the point. It's because it's the repetition that builds retention over time. When you hear it again and again, you tend to remember it. Advertising does the same thing. It used to be that you had to see an ad 7 times before you remembered it. Now it's more like 15 to 20 times before you remember it. So yes, and again, I'm repeating what I repeated, that I repeat myself. I'm aware of it.